What if I told you that investing just $19 a day could eventually turn into a full-time income of over $59,000 a year? You'd probably think I'm lying, and for good reason. It sounds too good to be true. But it's not, because by leveraging the power of dividends, $19 a day can really grow into more than the average salary of the US of $59,228 a year. And in today's video, I'm going to show you exactly how to make that happen with the Dividend ETF SCHD. What is a Dividend ETF? To really understand how this would work with SCHD, you first need to understand what is a dividend. A dividend is a portion of a company's profits that are paid out to its shareholders. For example, let's say that you own 10 shares of a company, and that company pays a dividend of $3 per share, meaning you'll get $3 for every share that you own. With the 10 shares that you own, you'd be getting $30 in dividend income. Dividends can be paid out at different times depending on the stock or the ETF, such as monthly, quarterly, semi-annually, and annually. And in SCHD's case, it's a dividend ETF that pays out quarterly. The amount that you'll get paid will differ between different companies and ETFs. And oftentimes, you'll hear the term dividend yield, which is used to give an idea of how much you can expect to earn in dividend income, but more on that later. Since dividends can provide a steady stream of income, this makes these type of ETFs with great dividend yields and solid historical returns so popular. And that's where SCHD comes in. What is SCHD? SCHD is the Schwab US Dividend Equity ETF. Essentially, it's a collection of stocks focused on high-yielding and high-quality dividend-paying stocks. And a nice thing to note is that SCHD is not managed by some fund manager or a team that's trying to beat the market. Instead, it's passively managed, which in this case, it just tracks and invests in the same companies as the Dow Jones Dividend 100 Index. And this index focuses on high dividend yielding stocks in the US that are fundamentally stable and have a history of consistently paying out dividends. Since SCHD tracks the Dow Jones Dividend Index, its holdings are the same as those found in the index. Holdings, of course, refers to the companies or stocks that the fund invests in. For SCHD, these include Pfizer, Cisco Systems, Coca-Cola, AbbVie, Chevron, along with a few other notable companies. The companies in SCHD all offer dividends and also span over a variety of industries, which helps increase diversification and reduce risk. When broken down by industry, this includes sectors like finance, healthcare, consumer staples, industrials, energy, and a few others. What's even better is that SCHD is mainly composed of blue chip stocks, which are essentially large, financially stable companies with great reputations. When investing, this is important because it shows that the company is viewed as safe due to the low volatility and risk, reliable returns, and the fact that they're well established and not likely something that would collapse overnight. Now, when it comes to cost, SCHD has an expense ratio of only 0.06%. This means that for every $10,000 invested, you'll only be charged $6 in fees. And I know what you might be thinking, all this is great, but how much will you actually make in dividends if you invest in this ETF? Let me show you. Oh, by the way, if you're getting value from this video, be sure to hit the like button and subscribe for more content like this. The dividend yield. The dividend yield shows how much a company pays in dividends each year relative to its stock price. To give you an idea of how dividend yield is calculated, imagine a stock is priced at $100 and it pays an annual dividend of $4. That means that the dividend yield would be 4%. When it comes to SCHD, the current dividend yield is 3.54% as of this recording. And SCHD ended 2024 with an all-time high fourth quarter dividend payout, along with an annual dividend of 99 cents per share. Now, it's important that you keep in mind that dividends are paid per share and not as a percentage of the value of your shares. So if the shares you owned in a company had increased in value by 20%, let's say from $100 to $120, that doesn't change the amount that you'll be getting paid in dividends, since again, the payout is per share that you have. SCHD returns. Now, speaking of dividends, one great thing about SCHD is that when it comes to their dividends, year after year, they've been getting better and better. You see, companies don't just pay a fixed amount. Dividends can increase and decrease over time And the annualized percentage of this is called the dividend growth rate. For example, if a company pays $1 in annual dividends and the following year they raise it to $1.10, that would represent a 10% growth rate. What's so great about SCHD is that over the last 10 years, it's seen annual dividend growth of around 11%, and it's had 13 years now of consecutive dividend growth. This is a big deal because this dividend growth offers a hedge against inflation, since that dividend income is helping to pad your investment. Or you can think of it as you're getting a bonus or a pay raise from your job, where your salary is increasing every single year. But like with anything that involves income, there are always some type of tax implications involved, and dividends are not immune to that. So let's talk a little bit about that. SCHD tax obligations. Taxes are generally pretty complicated, and it doesn't get any easier when discussing dividends. To start, you'll need to understand the difference between an ordinary or non-qualified dividend and a qualified dividend. Non-qualified dividends are taxed as ordinary income. This means that the amount you earn from the dividend is taxed at your ordinary income tax rate, which ranges from 10% to 37% for federal taxes, depending on your income level. Then you have qualified dividends, which are taxed as capital gains rather than ordinary income. To keep it simple, qualified dividends are those that meet certain requirements by the IRS and are therefore taxed at a lower rate, which is the same rate as long-term capital gains tax rates. This lower tax rate will depend on how much you've earned from dividends. For example, for 2025, if you're single and earn under or up to $48,350, your tax rate will be 0%. Then earnings above that rate will be taxed at 15%, and then it'll rise again to 20% for income that's over $533,000 a year. SCHD falls under this since it pays out a qualified dividend, but keep in mind that any dividends that you earn in your Roth IRA or other tax advantage accounts will not be taxed as long as you keep them in that account. By this point, you now know what a dividend is, what makes SCHD so great, and also how taxes work when it comes to dividends. So now I'm finally gonna show you how that $19 a day can turn into a full-time income, the Dividend Calculator. So let's jump into this Dividend Calculator and assume that you begin your investment journey with a base of $1,000 in your account. Considering you're buying SCHD, the dividend yield is 3.54%. The dividends are quarterly, and you choose yes for DRIP, since this is your dividends being reinvested to buy more shares. Let's say you're maxing out your Roth IRA contributions each year with $7,000. That's $7,000 divided by 365 days in a year, which equals roughly $19 a day. Now let's be conservative here and assume a dividend growth rate of 8% yearly and a yearly price appreciation rate of 6%. And we'll set a tax rate of 0% since this isn't a Roth IRA. And let's say you do this for 30 years. By the end of 30 years, you'd have a total balance of over $1.4 million with an annual dividend income of over $90,000. I'd say that's a nice chunk of passive income to be earning yearly. And if we go back and assume this was invested in a taxable account and we apply a 15% tax rate over the same time period, the total balance would drop to $1.2 million with an expected dividend income of just under $80,000. So for just $19 a day, you can generate passive income well over the median US salary in only 30 years without ever lifting a finger. And of course, by investing more, you can easily cut down this time frame and have even better results. The reality of SCHD. But as great as SCHD is, it's not the end-all, be-all of ETFs, and it shouldn't be your only holding. A solid portfolio is one that's diversified, so having exposure to more industries, segments, and asset classes is most important. You can pair SCHD together with a wide variety of other ETF funds, such as one that invests in the S&P 500 index, like VU, SPLG, IVV, or others, or one that gives you exposure to all the stocks on the US stock market, like VTI, ITOT, and SCHB. If you want more exposure to growth stocks, real estate with REITs, international markets, bonds, whatever it is, it's ultimately up to you and what your risk tolerance age, and retirement goals are, and most importantly, what you're most comfortable with holding. I'm sure by now you can see how powerful dividends and the income they can generate can be over the long term. And if you want to learn more about some other great ETFs for your portfolio to look at, be sure to check out this video here. And if you enjoyed the video, be sure to hit the thumbs up and subscribe. Thanks for watching, and I'll see you in the next one.